All right, everybody, long time no talk. Welcome back to another episode of Matt Money. I'm your host and your boy, Matt. Today we're going to be talking about M1 Finance. So, I'm changing up the strategy a little bit. So, I don't want to go too much into detail as like all the reflection and stuff like that went into what's going to be happening. But what I want to talk about specifically in this video is how I'm changing up my M1 Finance sort of strategy. So, I think some of you guys in the past may have known that I used to utilize M1 Finance to buy individual stocks. That's going to change, and we're going to walk through that today. But before we do that, let's just take a quick moment to recognize that 2/3 of you guys watching the video aren't even subscribed to it. So, Bill, if this is your third or fourth time watching and you haven't subscribed yet, and you like the videos, man, I don't know what to tell you. Let's just go ahead and hit that subscribe button down at the bottom, and let's just get it kicking, man. Make sure that you share with family and friends as well. So before we actually hop into M1 Finance, let's do a quick portfolio look. So we are $12,000 away from hitting 500,000 US dollars in the portfolio. We're making about $14,785 in income in the next 12 months, unless anybody cuts or raises the dividend. That will change. So far this year, we're looking at about $4,600 in dividends collected, but we're still hoping to get close to that $13,000 mark, $13,000 to $14,000 mark before 2020 is kind of closed out. So for those of you guys that are kind of doing the math, looking at the 341 or the 488 and multiplying it by the 400 or 4.33%, it's not going to add up. It's because I have a little dividend portfolio aspect of things. I got the 401k aspect of things. Can't really pull out everything from the 401k, unfortunately. So unfortunately, we're just kind of left with the 341,000 that's in the dividend portfolio. So technically, this number would probably be higher, but then again, it's in a retirement account. Can't really access it anyway. So a lot of this stuff I'm actually able to come into my account every single month. So some months you'll see, like last month we had 800 something in dividends. This upcoming month in June, I think we'll be getting $1,500 to $1,600 in dividends, plus whatever money in Shopify and stuff like that. So we'll talk through that as well. So if you guys are interested, make sure you follow the channel. So actually hopping into M1 Finance. So you guys probably recognize now that I've been kind of increasing this by about $250 every couple months or so. And so what I was basically doing initially was kind of going after Visa, Johnson Johnson, and 3M, and then eventually I kind of got into this QQQ and IBB kick. I don't even know if I made a video about kind of switching that up, but regardless, I just really wanted to kind of pull back on that. And now that I'm getting to the point where, with a bunch of different other things kind of going on with dividend investing, Shopify, and potentially YouTube as well, all that income kind of combined is really allowing me to kind of meet a lot of my basic expenses. And so what I basically want to do is, I don't want to say take a full step off of dividend investing, because that's not what I want. But the real reason why I was doing a lot of dividend investing was specifically to meet my basic expenses. And now that a lot of my basic expenses are kind of met or very close to being met at the moment, what I basically want to do is kind of go back towards more of that growth, right? So there's a lot of other opportunities that I want to seek out there. And a lot of the things that I was kind of scared to do in the past, I can now start to kind of do, because I have that sort of underlying base of dividends that I can kind of utilize. And yeah, I know you're probably sitting there saying, $2,000 a month with Shopify income, YouTube, and dividends isn't a lot. But hey, I mean, that's going to keep me off of the streets. It's going to keep me from only eating like ramen noodles and peanut butter and jelly sandwiches. So, in most countries in the world, I could actually live off that $2,000 a month and be really happy. And so, if anything were to happen in my 9 to 5 job at the moment, that's probably what I would do. Um, but that being said, it allows me to kind of fast track more into the growth aspect of things, because since I'm only 29, it makes a little bit of a difference now if I'm able to get some of these things into growth. So as you can see right now, the actuals for Visa, Johnson & Johnson, and 3M are just under 30%. And that's because I basically started off the portfolio with like 5,000 to then $7,500 in the portfolio. And a lot of it was split between these three stocks. So now what I've really started to do is change it up and actually go to ITOT and QQQ. You can see that these two positions are really accounting for 90% of the portfolio, and then the other 90% is kind of split between Visa, Johnson & Johnson, and 3M. And so the reason why is because I really like Visa, I really like Johnson & Johnson, I really like 3M. I think those are good companies. And so I don't just want to sell off these $3,000 positions. And so while they're really overweight right now, we're not going to get any capital added to these at the moment. But through time, once we kind of get the portfolio evened out and once these positions kind of grow, hopefully we can have a little bit of extra contribution to those. So I previously have been adding about $250 every couple weeks to the portfolio. I've now switched to having about $375 every 2 weeks. So I've upped it from $500 to $750 every single month. And I might actually increase that now to more closer to $1,000 a month. And so now we have $375 going directly into ITOT and QQQ, and that will happen twice a month. So the first of the month and the 15th about of every month. So for those of you guys that aren't really familiar with what ITOT and QQQ are, ITOT is basically a total stock market fund. So if you're in Vanguard, this is equivalent to your VTI, or I'm trying to think if there's any other ones, but I don't remember exactly what the Vanguard mutual fund one is for the 401k, VTSAX or something like that. But this one is specifically going to be going for iShares total stock market. So what it is about 3,600 different stocks. And obviously it's got the S&P 500 in there. It's got a lot of the small cap 600 in there, a lot of the companies in the Russell 2000 in there. And so it also, what I wanted to basically have in here as well is it also incorporates a little bit of the micro cap or nano cap or whatever the heck they're called. And so if you're in VTI, that only has 3,500 stocks. This one has 3,600, so it's got an extra 100 really small companies as well. But that being said, it's not going to be equally weighting those 3,600 companies, so it is heavily skewed towards the S&P 500. So it's basically just looking at the total stock market and taking the market capitalization of all these companies and kind of dividing it up into a 100% pie. And so your big companies are going to hold a lot of the big pieces of it as well. So really low expense ratio, which is one of the things that attracts me to it, and also 1.94% dividend yield, which is also something that's relatively cool. Have about 25 billion under management at the moment, but one of the things that I also kind of keeps me up on my toes is that it generally speaking performs better than the S&P 500, but it's also slightly more volatile than the S&P 500. And so if you were to kind of look at ITOT over time, and let's just say the portfolio view of things, if we can kind of look at it, if it allows me to. No, it does not. But if you were to kind of compare it in terms of looking at, say, the S&P 500, let's say, what you'll see is that it's slightly more volatile than the S&P 500. So what you'll see is it's kind of got a pretty good jump up here in terms of total dividends. But how can you compare these relatively quick to the S&P 500? So let's just look here. So you can see it's performing really well. So over the past 5 years, it's up about 50%. And then compared to, say, the S&P 500, if you just pull that up, it's up about 53%. So this might not necessarily be the best, I guess, target group to look at, comparing, say, S&P 500 and ITOT. But over time, generally speaking, small cap stocks outperform the large cap stocks. So if we kind of look at IJR, this might be a bad representation as well, because probably stocks are really heavily pulled back right now. But anyway, if you look over time, generally speaking, small caps way outperform the large caps in terms of things. And then, so yeah, this is basically just going to be looking at the majority of a lot of the companies in the S&P 500, but also including a whole bunch of other small cap companies as well. And then QQQ is an ETF product that specifically focuses on the NASDAQ, more specifically the NASDAQ 100. And so this personally, compared to the S&P 500, is up almost 2.5 times comparatively. So the S&P 500, if you looked at it over the past 5 years, is up about 55%. This is 121%. So that's not obviously like apples for apples, right? Because you're investing in the NASDAQ versus the S&P 500. And we all know that technology has done a really good job over the past 5 to 10 years of growing. So Do want to also note that this has about $110 billion under management, so slightly more than ITOT, and the expense ratio is much higher as well, so 0.2%, which is generally speaking getting close to that point where I'm like not worth it. But comparatively to a lot of the other ETFs that are out there, the NASDAQ 100 is a phenomenal index to kind of keep track of. And so QQQ, in my opinion, is really good. There are some folks that have asked me, why aren't you doing XLK or something like that? And that just has to do with a lot of the companies that are kind of in XLK. So XLK is actually slightly overperformed compared to QQQ. But that being said, I'm not the biggest fan of the what is in XLK compared to QQQ. So the first two stocks I think are probably going to be very similar. So if you look at QQQ and XLK, it's probably still going to be Microsoft and Apple. But if you go a little bit deeper into the top 10, in QQQ, you're going to have your Amazons, your Googles of the world. Whereas I think in XLK, I don't even think you get Amazon or Google. And so I think you get more of like the semiconductors. So if you're into semiconductors, maybe XLK is for you. But this is kind of what I'm looking at in terms of my strategy. And so every single dividend that kind of gets combined is probably going to, for the near term future, going to be going into ITOT and QQQ. And so I'm hesitant to rebalance at the moment because you can see, we're up pretty good on Visa, we're up pretty good on Johnson & Johnson, we're up pretty good on 3M as well. And all these are up pretty good. But obviously, if we were to rebalance, that would sell a lot of the Visa, J&J, 3M shares and then add them to the pie for ITOT and QQQ just based off the fact that I have that at about a 90% weighting. And so like I said, it is going to take a step back in terms of how much the dividends are growing from the portfolio, because obviously 1.94% and like 0.6 or 0.7% for QQQ is definitely going to put a slight hamper on the actual, or hindrance, I guess is the right word, on the actual portfolio kind of going forward. So we have about zero point 0.7 for QQQ. So that being said, it's definitely going to put an impact because for every, let's just say, $1,000 that I invest, it's probably only going to get me 12 and a half bucks or something like that in terms of dividend income on a yearly basis. So that's not really a big deal. I'm more so looking towards the growth now, what I can potentially do with the growth in the long term. Because, like I said, I mean, the near term is more so focusing on if I need the dividends near term, right? But now that I have those dividends kind of covered, I don't necessarily need those dividends unless something drastic happens, which, then I can fall back and utilize those dividends. Or I will be using them in 20, 30 years from now when I actually do, I guess, physically retire. But at the moment, I'm kind of trying to balance a little bit in terms of that aspect of things. Now, that's not to say that I'm not still contributing to the individual brokerage account. So for you guys that are familiar with it, the individual brokerage account is about $200,000 to $250,000, and I'll be contributing still to that. I think it's just I pulled back a little bit. I think what I did in the past was I contributed about 1,500 at a minimum a month to the individual brokerage account. Now I think I pulled that back to about 1,000 a month, and so that will kind of pull back a little bit. And that also has something to say because that brokerage account is probably producing around an average of $800 a month in dividend income. So I'm basically just trying to calibrate where the money is going, right? So obviously, M1 Finance is kind of like a managed kind of portfolio at this point, or very passive portfolio. And then I also want to try to do some real estate as well, and then also do some websites. So I'm basically just like avoiding throwing all the money in the brokerage account, which in the past has worked extremely well for me. But I'm trying to see if I can get some of these other passive income streams up, like the real estate and website stuff as well. So that's relatively it. Just kind of wanted to share with you guys the changes that we had in M1 Finance and really what we're looking at. So far, so good. We're up about 10% on everything um, in terms of the portfolio as a whole. And we started this, I guess it was like 3Q of 2019. And so while this isn't necessarily the biggest part of the portfolio, because there is the 488-ish thousand and a lot of other different places throughout the different portfolios and mostly in Fidelity, a lot of people like this. And I think that this is also going to be something that I utilize going forward a little bit more, just so that I can kind of invest, but also kind of have a little bit more of a hands-off approach, and kind of just let it do its thing. And I guess, I have contemplated the thought where I could add in like a VYM or a high dividend sort of fund in here, and get myself like a little bit extra in terms of dividends. And I think it would kind of even out with respect to growth, right? Because you have QQQ, which is higher growth, and you also have the ITOT, which is higher growth, and then you would have like a high dividend fund, which might not be higher growth in terms of capital appreciation, but you'd also get the dividends aspect of things. So it's going to merge, I assume, with time, and I guess I just have to kind of feel it out. But I do want to take a step towards that kind of automated process, and so that is this first step. And I wanted to share that with you guys because it's been a couple days, or a couple weeks rather, since I shared an M1 finance video. So really hope that was helpful for you guys, and I'm probably going to make another couple of videos tonight and release them throughout the week. So thanks guys, I'll talk to you in the next video. Cheers.